Hello, this is Dr. Lindsay, and this video is on real and nominal interest rates. So now that we've gone over inflation, we can go over this nominal and real interest rates. So just like there's nominal and real GDP and nominal and real prices, there's also nominal and real interest rates because inflation has an effect on interest rates. So we use little I for a symbol for nominal interest rates and little r for the symbol for real interest rates. Nominal interest rates is just the interest you pay to borrow money or to lend money. So for example, let's say you loan somebody money for 1 year and charge them 10% interest. That's the nominal interest rate. And little I would be 10%. But if there's inflation going on, after 1 year, you get 10% more money, 10% more dollars, but it's not necessarily going to buy 10% more stuff with that money because there's inflation. So if there's inflation of 5% during the year, then really you're only making like 5% interest in real terms. And if inflation's 10%, then really you're not making anything in terms of interest that you're earning. And if it's higher than 10%, you're actually losing money because you're not going to be able to buy as much as you could afterwards. So this is where this inflation expectations are important. If we're going to loan somebody money, we need to know what inflation is going to be over the next year, what we're expecting for inflation, and hopefully there's no unexpected inflation that's going to be causing you to lose out if you're a lender or to gain if you're a borrower. So the real interest rates is after adjusting for inflation. So let's say you loan somebody money at 10%. That's the nominal interest rate. And if inflation is 10%, then the real interest rate is 0. If you loan somebody money at 10% and inflation is 3%, then the real interest rate is going to be 7. And if inflation was actually higher than the nominal interest rate, let's say 15%, then the real interest rate would actually be negative 5%. So real interest rates could be negative if the inflation rate is greater than the nominal interest rate. The Fischer equation is an equation thought up by someone named Fischer, of course, Irving Fischer. And what he said is the nominal interest rate little I minus the inflation rate pi would be equal to the real rate. So we can just write this as I minus pi equals R. Or we can write this as the nominal rate equals the real rate plus the inflation rate. Now, the interesting thing here when we're talking about real and nominal interest rates is that both of them can be positive or negative. Nominal interest rates can be positive or even occasionally negative. 30 years ago, economists didn't think nominal interest rates could ever be negative. I mean, why would you loan somebody money at something less than zero, where you're paying you back money less than what you're borrowing? But some weird things have been going on in the last 20 years, and believe it or not, many government bonds around the world have a negative interest rate on them. Just a little bit, but negative nonetheless. Let me just show you. Right here today, I'm looking at interest rates on the German bonds. This happens to be the 10-year German bond, the Bund. And the interest rate on it is negative 0.29%. So about a third of 1%. By loaning the German government money, you get a little bit less money back in the future. So the way this is done is you buy, say, 1,000 euro bond, German bond, that in 1 year they pay you back 1,000 euros, but you're buying it today for something more than 1,000 euros. It's very bizarre. You think about it here. Why would this happen? There's some reasons for it. It's unusual. It's been going on for about 10 years. It's just kind of a freak thing that's been going on here that never went on before in history, that these government bonds would be paying negative interest rates. It hasn't really happened yet in this country, in the US, except it did for a very brief period of time with one of the government bonds. They've been essentially at zero for quite a while, and they just one day they dipped below it into negative territory, but it can happen. Also, so we have negative nominal rates. It can happen. Particularly here, it's been happening with the US government bonds. And if you think about it, well, if you put money in a checking account that pays no interest, but they charge you a fee, then it's almost like a negative interest rate. And that's for the convenience of having a checking account, place to store it. And so there's some advantage of having these government bonds, like the German bonds. At least it's safe. It's a way to store it, paying a small fee to store the money. If you stored it at home, you're going to have a security guard. If you put it in a bank account, you might have to pay a fee. So if you required for some reason or another to hold different European government bonds for one reason or another, maybe your bank or something, then you actually have to, and then you're paying a little bit of money for that convenience. It's hard to see nominal interest rates going too far below zero, 0.5% or so. I think I saw them going as low as 1% negative, and on some of the foreign country European bonds, but I don't think they could go really much below that. Real rates can go below zero too. There's an interesting thing about real interest rates. They can be positive and negative too, and they're not constant from year to year. So let me show you a graph of real interest rates in the United States over a period of time. This was a period from about 1950 to 2005. This is the real interest rate on the 1-year Treasury T-bills that you could buy from the government. So this is, you take the nominal rate, and then you know what the inflation is and subtract it off, and you can look through history and see what these bonds have been paying. And one thing that's pretty obvious right from the start is that this real rate is not constant. It bounces around from year to year. And you can see here in the early 80s, the real interest rate was almost close to 10%. And yet there's been times when the real interest rates are negative. Here in the 70s, real interest rates were negative quite a bit. Again, the reason why is that there was a lot of inflation in the 70s, and it was higher. The inflation rate was higher than the interest was earning from bonds. It also happened in the early 2000s, and it's also been occurring lately here. In the last 10 years or so, it's been happening quite a bit here in the US for interest rates, real interest rates that become negative. So, real interest rates are not constant over time. Just like nominal rates go up and down over time, and they can become negative. Okay, so just to recap here, we've got both nominal and real interest rates. Nominal interest rates are what you would pay to borrow or loan money. Real interest rates are after adjusting for inflation. And the relationship between the two is fairly straightforward by this Fischer equation. We just subtract off the inflation rate from the nominal rate to get the real rate. And these real rates bounce around quite a bit and can be negative sometimes. The nominal rates are usually positive, but in some instances, for some things, they can actually become surprisingly negative at times. Now, let me ask you something. What do you think would happen if inflation showed up here in this country over the next several years? What do you think would happen to interest rates? Well, if we start increasing the inflation rate, something's going to have to change in this equation. And what will happen is it'll increase the nominal interest rates. Probably won't change the real interest rate. The inflation rate doesn't change the real interest rate, other things do. And if it's not going to change the real interest rate, that means it's going to have to change the nominal interest rate. So we would expect if inflation starts to pick up and it's higher, then we would expect to see nominal interest rates pick up too.